Good morning, everybody. Finding the key to thriving investment is the title of this next panel session. And we're going to focus on cross-border capital flows, both outward and inward. ODI, outward direct investment, is very, very important to us all in this room. It's important that New Zealand builds up a stock of offshore investments that generate a diverse stream of revenues for New Zealand into future generations. In the same way as foreign direct investment, which we've talked about in several of the sessions this morning, is also vital to New Zealand. We've talked about a well-known productivity gap that we have in New Zealand, and the only way that productivity gap is going to be solved is through the injection of capital. And part of the reason why we're so poor around offshore direct investment and rank very low in OECD terms is the fact that we don't have a lot of capital available to us, and that's why offshore is a wonderful source and a vital source of foreign capital for New Zealand and its future productivity. So the panel session is going to focus on both the offshore piece and then capital coming back into New Zealand. And to do that, we have three people, as you can see. I'm in banking, I can count. We have Cathy Quinn from MinterEllisonRuddWatts. Cathy was the former chair of MinterEllisonRuddWatts. She was made an officer of the New Zealand Order of Merit in the honours lists in 2016 for her contribution to the law and woman. She was the Veuve Clicquot Businesswoman Award winner in 2010 for New Zealand, and she's on the board of Fletcher Building Tourism Holdings, the Treasury, and the New Zealand China Council. Rob Hewitt has been a director of Fern Farms from 2008 and chair since 2013. He comes from a primary sector background, and in addition to Fern Farms, sits on the board of Turners and Growers, which has a cornerstone shareholding out of China from the Joy Wang Mao Group. He's also on the board of the Farmlands Cooperative and Hilton Haulage. Judith Swales is from Fonterra, where she heads up Fonterra's global consumer and food service business, which includes Fonterra's operations in China. She's been with the co-op since 2013, previously as Managing Director of the co-op's Oceania business and then Chief Operating Officer of Fonterra's transformation and innovation function. And we're going to start with you, Judith, so thank you.
Thanks, Paul. Good morning, everybody. I think as a number of people have already said, I'm just going to get my first slide up, I hope. China is an exciting place to do business, and it's a very important market for Fonterra. And I think these three random numbers probably best demonstrate that. So in no particular order, 26% of all the milk that Fonterra collects heads to China. 36% of dairy imports into China come from Fonterra, and 11% of the dairy consumed in China also comes from Fonterra. So you can see just how important and the scale of Chinese customers to the Fonterra business. But it's not just important to our bottom line. And to the point that I think the Prime Minister made earlier, it's really the insight it gives us around consumer trends, and particularly the importance of food safety and quality, which is becoming increasingly important in many geographies across the globe. So you would say that Chinese customers certainly are keeping us on our toes. But establishing our foothold in this market didn't happen overnight. It's taken many, many years, and it's taken investment. It's a unique landscape, so it also means that we have made mistakes and we've had to learn along the way. We have a strong, full business in China. It's made up of our consumer brands, it's made up of food service and our ingredients business, supported by our China farms. Our consumer business, led by our anchor brand, is the number one imported dairy brand in many categories in China. Through our food service business, we partner with bakeries, restaurant chains, and beverage houses across China. In fact, 90% of bakeries choose our butter. And as Minister Parker said, our UHT cream has been used in 500 million tea macchiatos. And if you ever go there and you haven't tried one, I recommend that you do. They're quite something. China is consistently the largest purchaser of Fonterra ingredients on our fortnightly global dairy trade platform. And our China farms provide premium fresh milk to Chinese consumers on every day through partnerships with the likes of Hema Fresh and Carrefour. So all up, our business in China generated nearly $4 billion in sales last year. This is a great position to be in, but as the Prime Minister also said, China is a dynamic market, and with that you need to be prepared to be agile, to change and hustle and compete, and to be able to change quickly how you get to market. It's common knowledge that we made significant investments in China, most prominently in infant formula company Bingmate, and also in our China farms. In 2015, we took an 18.8% share in Chinese infant formula company Bingmate Baby and Food Company. Bingmate has real strengths in R&D, in manufacturing, and importantly has a very strong food safety and quality record in China. But it's fair to say that we have been disappointed in how Bingmate has performed, and we've had to learn some tough lessons along the way. We saw them get left behind in the market, and as consumers were moving very, very fast into e-commerce, they were slow to respond. And we've had a big stake and big exposure. The dynamic nature of China and the market should be a key watch out for anyone competing there. Similar with our China farms, we have 2 farming hubs in China, but continuous rainstorms and floods have impacted our milk production and subsequently our sales volumes, and our farms were loss-making in the first half of this year. Pleasingly, there are signs of improvement though. The domestic price is lifting towards the magical 4 RMB level, but importantly also, we're starting to see demand for fresh milk start to grow. Our consumer and food service teams are continuing to make small steps to capitalise on China's trend towards fresh milk. This includes launching fresh milk with the likes of Hema Fresh and Carrefour, but also partnering with cafe chains like Starbucks. We were there recently and listening to the CEO of Starbucks in China. They anticipate opening 700 new stores a year, so that's 2 a day, to really capitalise on this growing trend the Chinese consumers have for coffee, like the rest of us, I guess. We've made some big investments in China to establish our business there, but investments don't just need to be large and capital in nature. Some of our most significant investments in China may just be in the relationship that we formed over many years. 770 million consumers, that's this number on the screen, is how many consumers shop online in China. 800 million are connected to the internet. It's on a scale that's hard to believe, and interestingly, 55% of all our consumer sales are online. Partnering with China's e-commerce giants is now the cornerstone of our consumer strategy there. These investments have helped us to get a foothold in the China consumer market. Alibaba is the world's largest retailer, and I'm pleased to say that we have great relationships with them, as we do with JD.com. There's also a strong network of New Zealand exporters in China, and we collectively share knowledge, insights through such forums as the NZ Business Roundtable in China. So with all the learnings we've gathered over the last couple of decades, including identifying our strengths and understanding how we can win, understanding the market's unique dynamics, how will we keep competing and growing value in the China marketplace? That is something that is very much a part of the full strategy review that we are considering right now, right across our business. But I think what we can see clearly over and over is the importance of trust, the importance of New Zealandness and the value that customers put on that in China, and importantly, the value and the absolute imperative to stay agile and remain innovative to continue to win in the market. Chinese consumers are increasingly provenance motivated, and they want a product and a brand that they can trust. This led us to invest in our own traceability technology that we call Trace. We've just completed the global rollout of this tool, And what that means is now we can trace the origin of any of our products anywhere in the world within minutes. 99% of all Fonterra's New Zealand milk is now electronically traceable back to farm collection. We're proud to say and to be the first dairy company in the world that can do this. As well as bolstering our food safety and quality credentials with regulators, Trace also reinforces our provenance messages with consumers. So, for example, consumers in China can take a can of our Anmum infant formula. They can scan a QR code and it will bring up a map of New Zealand and it will pinpoint the region where that milk has come from. And of course, that allows us in time to be able to pinpoint, hopefully right back to the farms. It's these elements that set us apart, and this will build trust and contribute to our ongoing success in China. But what does the future look like? China will undoubtedly remain an important market for us. Fonterra, as I've said, is reviewing its strategy and its portfolio of assets globally, and this includes China. When we're not tinkering around the edges here, this is a fundamental change is required. However, when we look at all the indicators, the outlook for China market is positive, and we can only see it remaining positive for the long term. And this is underpinned by a consumer appetite for value-add dairy ingredients and for Western-style food and drink. So demand for dairy is forecast to grow at nearly 4% a year from now until 2030. But importantly for us, local milk production is not expected to grow that fast. So China will need to import the equivalent of 21 to 25 million tonnes of product by 2030, more than double the current import volume. Growth in local production is hindered by the fact that in China is an expensive place to produce milk, with production costs nearly double that of New Zealand, and only 7% of the land there is suitable for arable production, meaning that feed needs to be imported. As a dominant importer in many categories in China for dairy, with good market access and a strong supply chain in place, we believe that we are well positioned to capitalise on the expected increase for demand in dairy in China. But I think, as a number of people have already said, China is not a market to ever take for granted. So I think it's fair to say it will continue to keep us on our toes. Thank you.
Thank you, Judith. We'll come back to some of that when we go into the Q&A piece at the end. So we'll just pass straight across to you, Cathy.
Good afternoon, everyone. The proposed reforms to the Overseas Investment Act are wide-ranging and they go well beyond a national interest test. The Treasury released a paper in April this year. Submissions close on the 24th of May, and anyone interested in investment in New Zealand should read it. It's a joy, 117 pages. You should make submissions because otherwise it is a lost opportunity and we may end up with a regime that is worse than we currently have. The paper recognises that the current law is complex, time-consuming and may discourage investment. There are options to each of the issues identified. Some simplifies things, others actually add more complexity and requirements. In fact, in reading it, it was like officials felt nervous about making things easier. My sense was for every suggestion to simplify things, then there were options which may actually make things worse. It's a bit like, from my perspective, giving with one hand and taking back with two. I'm just highlighting some of the key changes. Sensitive adjoining land. Currently, if you buy a property or lease a property next door to sensitive land, you need to get OAO consent. Frankly, I think that's ridiculous. The fact you're buying or leasing a property next door to a park, the park still remains despite the fact a foreigner has leased or bought that property. There are proposed options to narrow the definition of sensitive land to avoid this nonsense, but it will remain, quite rightly, for lakes and foreshore, and a property significant to Māori will remain needing consent. Similarly, leases. Currently, if you've got a lease of 3 years or more of sensitive land, you need to get consent. Again, really, does it really matter who owns or leases a commercial property? There is some options to deal with that, and the intention is distinguish between non-urban land, residential land, and other types of land. So say like a lease of a commercial building of less than 35 years would not need consent. The definition of overseas person currently captures many New Zealand listed companies who in reality are not controlled by foreigners. Capturing these entities just adds compliance costs and adds no value. So for example today, Fletcher Building, if it wants to buy a property, sensitive land, needs to get OIO consent unless an exemption applies. No value in that. We actually want Fletcher Building to buy land and develop it. There are a variety of options the paper proposes. I'm not sure all those options work, but I urge anyone involved in advising a listed company or as a director of a listed company or an executive to actually look at the options and make sure what's proposed works for you. If not, make a submission. The definition of portfolio investor, there's currently an exemption for portfolio investors. It doesn't work. There are a number of options proposed. I think the best option proposed is a class exemption for portfolio investor, where its policy is to limit its interest in New Zealand entities to minority investments and not seek control through board representation. There are way more restrictive options also on the table. Currently, New Zealand listed issuers can be tipped over to become an overseas person by a relatively small acquisition of shares by a foreigner. It's not actually easy for foreigners to necessarily be aware that their acquisition will push an NZX entity over to become an overseas person. One of the options proposed is that you'll only need OIO consent in that circumstance, where the NZ entity owns or controls sensitive land and where the foreigner will end up holding 5% after the transaction, which makes the New Zealand entity an overseas person. Looking at control of sensitive New Zealand assets. Currently, the law requires that where OIO consent is required, the applicants are controlled by persons with particular characteristics, including business experience and acumen, financial commitment, good character, immigration eligibility. This test imposes compliance costs, and very frequently it requires information from people who practically have no control whatsoever over the New Zealand assets. One might also query the OIO's ability to judge a person's business acumen and experience. A number of options are put forward. One option does narrow the information required, excludes New Zealanders who are currently caught by technicality, and introduces a new standing and consent for the investor test. There is a suggestion that the test be expanded to allow assessment of a corporation's character, such as a parent company tax arrangements, their labour and environmental practices around the world. Personally, I'm not in favour of making changes that make the regime more restrictive than it is today. I think in terms of tax, we want to make investors here pay their fair share of tax, and that should be covered by a tax law. And we want investors here to comply with our labour laws and environmental laws, and we have current laws that provide for that. The paper considers whether the benefit to New Zealand test should remain, should it be expanded, and perhaps suggestions around clarity of the delightful counterfactual test. The current benefit to New Zealand test requires investors to demonstrate the investment will or is likely benefit New Zealand, and if the relevant land is non-urban land of more than 5 hectares, benefits have to be substantial and identifiable. Decision makers examine the proposed investment against 21 economic, environmental and cultural factors. The counterfactual test is used to determine if a proposed investment is likely to benefit New Zealand. That is a test created by the judiciary and is an absolute nightmare. The test compares what is likely to happen if an overseas investment proceeds with what is likely to happen if it doesn't. The OIO generally considers that a competent and adequately funded alternative New Zealand purchaser would be the most likely counterfactual. The paper notes that the current test limits the ability for decision makers to assess and manage national security risks with a particular investor. Options proposed in the paper include expanding the test to include national security, assess applications against a substantial harm test, expand the regime to allow ministers to decline consent in the national interest, and give ministers the power to call in transactions which do not currently even come within the regime. Looking at the substantial harm test, this is one of the options proposed. It suggested, as there is currently limited ability to decline transactions that could be perceived as presenting economic harm to New Zealand. The substantial harm test would allow ministers to decline investments that would damage the functioning of New Zealand society or threaten New Zealand political or economic survival, would severely damage the health and safety of the New Zealand public, or threaten New Zealand's economic well-being or national security. The proposed test would allow ministers to make the decision on substantial harm, not officials, and ministers would decide what was substantial harm, and this would reflect the government policy of the day. The quid pro quo for this proposal is that there would be a simplified benefit to New Zealand test that would apply to all acquisitions involving sensitive land. There would be no need to establish substantial and identifiable benefits, and a simplified counterfactual test would apply. The test is apparently similar to what is used in Japan and would be based on OEC guidance. But it will be, in my view, a danger is that it will be political. It gets to be decided by politicians. While we may not like the current law, at least in the face of the current law, we can tell clients whether or not they're likely to be able to get consent compared to deciding whether a politician decides whether something is of substantial harm. There's also a proposed new national interest test. It would be instead of a substantial harm test. You wouldn't have both. A national interest test would allow both positive and negative attributes of an investment to be considered. If a national interest test is adopted, guidance would apparently be provided on what constitutes the national interest. Reasons for declining an application would need to be published. Decisions would be subject to review. Now, other jurisdictions, such as Australia, have a national interest test, or other jurisdictions an ability to decline investment proposals for national security reasons. I think New Zealand is different. We have a lower domestic savings pool of capital for investment, and we are at the very end of the world. We've always needed foreign investment and will continue to do so. However, if the national interest test does go forward, it is proposed to remove the benefit to New Zealand test. If the benefit to New Zealand test remains, because there's also a proposal, there are suggestions that the counterfactual will be changed, and there are lots of variety of different proposals about how that counterfactual test would be redefined. The most sensible proposal is that the counterfactual is what the vendor would actually do with the land if it continued to own it. And if the benefit to New Zealand test remains, the suggestion is that it be simplified. In my view, there is some merit in us asking the question, would it be better to have a vague national interest test that would be political, that investors would have no certainty over, if it simplified the regime for 95% of cases? Personally, I'd prefer we gave investors relative clarity, simplified the current law, dumped the counterfactual test, and did not send a signal that investment was not welcome by adopting a new vague national interest test. The paper also discusses concerns that current risks, some types of risk are not currently considered under the law. These include water extraction, the integrity of the New Zealand tax system, and protection of Māori cultural values. My question is the OIO the right place to assess these matters? And does the OIO have the skills and resources to do so? Water should be dealt with by rates, tax under the Tax Acts, and Māori matters I think are probably dealt with adequately or could be beefed up under the Resource Management Act. Importantly, the paper does propose finally timeframes for the OIO to make decisions. Currently there is none. It takes way too long to obtain OIO consent in New Zealand, typically anywhere between 6 to 12 months for sensitive land. There are different options proposed in the paper with quite different timeframes. I suggest an adoption of timeframes for decisions would be very positive and should be supported. The reform of the bill provides an opportunity to improve our investment regime. Submissions close on the 24th of May. Let's not leave it to officials or those who are anti-investment or those with lots of time on their hands. Please read the paper and make submissions so we get a better regime. If we fail to engage, the regime could get worse and we'll have no one to blame but ourselves.
Thanks, Cathy. Your point about the 24th of May and making a submission is well made. However, I can't help myself but say there's a responsibility on people in this room to have a think about submissions that need to be made by the 17th of May as well in relation to the Reserve Bank changes to capital implications, which also going to have a big impact potentially on the future productivity of this country. So do that one first, and then you can turn to Rob.
I thought you were going to wait for me to talk before you said that, Paul, so good on you for getting it in first. Look, I thought I might spend a little bit of time talking to you about Fern Farms. And who is Fern Farms? I think it's worth just recapping that. Apart from perhaps chowing down on the odd steak or venison medallion over a barbecue, you don't have any idea who we are. This is who we are. We process about 30% of all red meat that is processed in New Zealand, and we export about 90% of that to over 60 markets around the world. We turn over about 2.4 billion New Zealand dollars. We employ 7,000 staff in 14 plants from Dargaville to Invercargill. Most of those plants are at the end of the line. You get in a plane, you fly to the nearest airport, you get in a rental car, and you keep on driving. The plants are incredibly important to the local communities, and that is something that we take very seriously. We are often the only game in town at any sort of scale at all. And we have 16,000 suppliers from Cape Reinga to Invercargill. I don't think we've got any on the Chatham Islands. We do have some on Waiheke. Many of them are our shareholders in the cooperative, and obviously the business is very important to them and their own businesses as well. This is our vision. We want to be the most successful red meat company in the world, grass-fed red meat company in the world, and that is a point of distinction that I'm going to return to later on. How are we going to do that? By sustainably adding value to everything that we do. It is a grass-fed platform, and I think the thing that's key about that is what we're not. This is not anything but 100% made of New Zealand. This is not anything but grass-fed product. We talk about health attributes, you talk about consumer attributes. We are tapping into these opportunities on a global scale, and not the least being in China. So we have some pretty big goals, and we've had a checkered past. So 2 years ago, in December just gone, we completed a transaction with Shanghai Meiling, who is now a 50% shareholder in the business. And I'll explain the company structure in a minute for a bit more detail. We had a number of issues as the cooperative over the time preceding that, but the guts of it was we basically had too much debt, and we needed to recapitalise. Our 16,000 suppliers, as I said, many are shareholders, either did not have the ability or were unable to recapitalise the business to the level that was required to go forward, and indeed the level that was certainly desired was a level past that again. So I guess the question that gets posed is, if not you who own the business, then who? Who needs the product that we sell? Who wants to be part of our story? And this kicked off a 2-year process to identify suitable partners, global trawl, to identify people who wanted to be part of our story. And we came up with, after a very long process and no domestic takers that were serious, with 3 offshore entities, and by far and away the most value came out of Shanghai Meiling in China. So why is this? Perhaps I should explain who Shanghai Meiling is. Shanghai Meiling is the meat business for the Shanghai government. There is a large organisation over there called Bright Foods, I'm sure all of you have heard of them, who is the food company for the Shanghai government, and Shanghai Meiling is a subsidiary of Bright Foods. They look after the meat production and a couple of other business interests as well, but fundamentally they grow and slaughter a lot of pork. They are the biggest pork producers in China at 1% of the market. Gives you an idea of the fragmentation that's over there. So why did they want Fern Farms? What was the key take-homes for them? Well, you saw our vision, you saw our purpose. They have consumers, as I'm sure you're all aware. The rapidly growing and aspirant middle market in China is demanding significantly more red meat protein than their domestic market can supply. And that top graph shows from Rabobank, sorry Paul, it's not one of your graphs, but Rabo had this for me the other day, the demand in meat, and this is imported meat, but the blue is the beef that's coming over recent years, and you can just see it's taking off like a out-of-control train. At the same time, domestic beef production on the bottom graph which is the green line that I've circled there, is actually in terminal decline. And Judith touched on this before. The reason for that is they've got limited pasture land available to grow big ruminants, whether they produce milk or meat, and that pasture land is pretty important for keeping the Gobi Desert out of Beijing. So any overgrazing on that pasture will be sand dunes in town in the not too distant future. So they're pretty keen to stop that from happening. And the simple fact of the matter is that demand does not equal supply. So Shanghai Mailing were very interested, Bright Food are very interested in Silver Fern Farms, principally because of the market demand over there, principally because of the demand for high quality food, and back when we transacted, high quality food meant imported. It's not so clear that that's the case now because Chinese producers are catching up very, very fast, and we can't take New Zealand and Australia's position as premium exporters out of to China and the product being demanded out of preference simply because it's imported from those two countries for granted, because Chinese manufacturers are catching up quickly. Healthy food, natural food produced in New Zealand, and the strategy was aligned to where Shanghai Mailing and Bright Food wanted to take the market for red meat over there. So Silver Fern Farms, preeminent red meat brand in China. This is the structure of the company as it stands today. So the cooperative, Silver Fern Farms Cooperative, owns 50% alongside Shanghai Mailing. The cooperative is owned by most of those 16,000 shareholders. And we are an equal partner in every sense. It is a 50-50 straight down the line. There are 4 casting vote issues that my co-chair has on the Silver Fern Farms board, but they understand something very, very well, and they got it quite early, is that they want the product made here, they want the product that's produced in New Zealand. Those suppliers of that livestock actually matter quite significantly to the ongoing business continuity of Silver Fern Farms. So to put it frankly, if you do something to cock it up at board level because of a Chinese mandate that comes out then that is well-intentioned but misdirected, then you run a jeopardy on destroying the business that you've just invested $267 million in. So they are very aware of our supplier base. They are very aware of the equal partnership, and it is a partnership that works well. We want them and they want us for different reasons, but we're aligned around values. And I think if there was one thing that I took home today from this presentation, it would be, if you are looking at investors out of China, spend more time on getting to know them and understanding their value set than understanding their bank balance. Because if you don't, it'll end in tears. Together, we own 50% each of Silver Fern Farms Limited, so effectively the cooperative has a board, which I'm the chair of, or until last week actually, I was the chair of that. I've stepped down from there, but I still continue to co-chair with my counterparty in Shanghai Mailing, the operating company, and we're the ones where the heavy lifting is done. So 2 years later, here we are. I get asked by Paul to come and talk to this august group, and I'm thinking, sure, what have we done in the last 2 years? We've actually done quite a bit. So the debt that was terminal has gone. We have seasonal debt where we go and buy livestock from farmers and then we sell it on to the market and then we repatriate that funds anywhere between 30 and 120 days later. But basically we have no core debt, and that makes the board papers delightful reading, let me assure you. We have no debt. We have invested significantly in a capital spend, $85 million over the last 3 years, with more to come. Our network needs investing in, not only because it's old, but also because of changing consumer demands and what we need to be able to deliver to them. And the investment in that space looking forward is going to be significant, none of which could have happened if we didn't have Shanghai Mailing's commitment and capital alongside us in the business. I can't read what else I put down there. Our farmers have accepted this very well. You know, this is just business as usual. There were the normal naysayers, I guess, that you get when you put a change of this sort of magnitude up in front of the audience. You're selling our business down the road. It's going to be controlled by China. They'll tell you what to do. The simple fact of the matter is China is taking more and more of our product at world-beating prices. They understand there are 60 other markets they need to compete with, and we will be selling into the highest and best market that we can possibly find. So it's about extracting extra value out of the supply chain. And New Zealand, and I'm sure Judith at Fonterra is exactly the same, we aren't going to be producing any more protein. In fact, we're probably going to be producing less. So it's about how do we extract value out of that as we move forward, and China is a key part of that market. So double down in China, I absolutely agree with that. Concentration risk, well, it's a calculated play, but at the moment I think the cards are squarely in our favour. And as I say, this is a mutual partnership. They believe the brand and the brand strategy and will create and extract value out of that themselves. We've already been doing it. This is in the CIIE, which is a trade show up in Shanghai last year. We had a reasonably large stand up there. There was a heap of interest around New Zealand product and what we do. You see the chap there in the blue overalls is actually one of our farmer directors. He's taking a carcass apart as we speak. And the degree of intensity, he looked up at one stage and saw 5 telephoto lenses virtually up his nose, and was wondering what the hell was going on from the boy from Tapanui. The interest in New Zealand is it's humbling for me actually. It's really, really impressive. And look, this is just the start because the brand is getting established. So I think it's even going to be better. The board, just to give you a flavour, we have 5 from the cooperative and 5 from Shanghai Meiling, including 2 New Zealand resident directors. One's an ex-colleague of Cathy's, Mike Schubert he was at Minters. We have 3 farmer elected directors on there, of which I am one. And then we have 3 from Shanghai Meiling. The biggest issue that we have is translation lag, and I think that is just a moment in time. So the short answer is, if Fern Farms is an example of foreign direct investment, bring it on.
Thanks. Thanks, Rob. While we read the questions coming through on the screen, I might kick off with one. It came up several times earlier this morning around the long-term investment horizons that come out of China. But having been up there recently speaking to some investors, one of whom is your shareholder, they, like us down here, are making sure there is a balance between that long-term investment horizon and a real discipline around return on invested capital. How do you see that playing out? Maybe start with you, Judith, given that you're going through a strategic review right now of your business globally and balancing up that long-term view with this requirement to deliver return on invested capital outcomes.
Although I think it's obviously a challenge, and the assets that we build are typically large in nature and they're significant investments. So, I think it all goes down to me is for understanding where are those consumer trends going and which are the ones that you can confidently back for the long term and really put your money behind. So when we think about it, we obviously think about things like Foodservice. Some of the trends that we're seeing, we don't see them abating any time in the short term. The demand for protein, that's not going to go away with an aging population. So I think really being able to pick the trends, what are they that give you confidence to put significant amounts of capital for those long term, but then it becomes the short term becomes a real problem, particularly when you have volatility in foreign exchange or in our case milk prices, is being able to weather some of those short term volatility.
Early days for you, but how are you facing into that?
Yeah, our investment profile at the moment is really catch up and putting a lot of effort into getting our plants ready to go. Our biggest issue right now is actually not investment, it's about access to market. And when I say that, I mean the likes of the Chinese ministries approving access for various product forms into market is very slow, and I know we're leaving money on the table today. So that would be something that I'd be very keen on getting sorted. Long term, I think we acknowledge as a company, I think certainly as an industry, that our investment in R&D is well under where it needs to be. We certainly need to understand the consumers in a lot more detail, and I guess if you look at the historical pattern of meat sales offshore, it's typically been through distributors, which by definition means you are distant from the market. And the more there are, and in China I can tell you there's probably, we deal with 2 big master distributors, and then I have no idea how that product gets out to the end consumer. It could be through multiple hands. And we don't like that. So we want to get closer to our consumer, which means investing in supply chains offshore. This is all basic stuff. It's not basic in lots of dollars. So that will be our profile, Paul, in the next wee while, as well as doing up our plants here.
Cathy, there's one here around New Zealand's capital gap, that first one at the top there. The question is around the government stance on foreign direct investment into farmland. Where's the capital going to come from to address the issue that we have around farmer succession issues? And as I said earlier, that's potentially exacerbated by what's going on with the Reserve Bank right now, given that banks aren't going to fill that gap. What's your view on that issue?
Well, no, I think it's a good question. I think it's quite difficult to answer, isn't it? I mean, particularly, and it's probably actually Rob and Judith are probably better positioned to comment because I'd be an outsider. But if you look at the cooperative, Silver Fern's a cooperative, Fonterra's a cooperative. If the farmers, I can understand why farmers want a really good milk price and want as much money to come out every year because that's what they live on. But where's the money to invest? And I guess that's a live issue that will, people are always talking about the capital structure of Fonterra. Let's see where that gets to in the next 2 years. And my perspective is it's usually been an evolving thing. So maybe over the next few years, we, who knows, 5 years' time, we might see part of Fonterra listed. I don't know. So I don't know that I can really comment more than that. I mean, these guys as sort of cooperatives probably have a better insight.
I'm happy to comment, Cathy. I think farmland is vastly overpriced, and if you're investing in it, you're an idiot. Said the farmer. It's a real issue. The rate of return on land assets in New Zealand is rubbish. So why would you have rocks in your head and go and put that money into a farm when you can put that 10, 20, $50 million into a productive asset and generate the required rate of return off that a damn sight easier? I think the question's actually slightly different. There's ways around this. There's going to be, assuming that land prices don't come back in the future, and I'm sure the bank's got a view on not collapsing that too much, Paul, given the amount of book that you've got. I think the fundamental issue is, yes, the rate of return off that land is no good, or not sufficient to entice investors in, and in equity programs, certainly in the sheep and beef space, very rare. Not so much in the dairy, but the rate of return on that is better. The concern I have is around carbon farming, and if I put my red meat hat on, I despair over this, because that carbon price at $25 a tonne at the moment is only going to go points north from here once the cap is lifted. And I can tell you that when you're running an extensive sheep and beef operation, even with buoyant prices like there are today, it doesn't take too many tonnes of trees to turn that into a pretty attractive proposition to change land use. And from a red meat perspective, that's horrific, because we've already had one crack at it in the 80s and 90s when dairy had to go. If I put my farmer's hat on, though, that's absolutely fantastic, because we talk about succession, grey hair. When I go to my shareholder meetings, I would be the youngest one in the room by probably 5 years. And these people are looking out. How do I get out? I've got 3 kids who all live in Auckland and drink what was that, a Frappa Kappa, whatever it was, and have no desire to come back to the farm, because in the 80s you told me that you'd have rocks in your head to go and do that. So I'm looking for an exit plan. Forestry may well be it. And I think there will be, ultimately land value will go to highest and best use. The rate of return off that will drive foreign direct investment.
Nothing to add there, Judith. Cathy, OAO decisions often take an uncommercial length of time to deliver. Should a maximum decision timeframe be imposed?
Yes, they do take an unreasonable amount of time, by and large. It used to be when I was much younger that we'd be quite proud of the fact that we could get OAO consent within, 30 to 60 days. And it would take the Australians 3 to 4 months. It's sort of now the reverse here. They can get it within a very short space of time, and we seem to have to wait forever. It's just unsatisfactory when you're trying to complete commercial transactions and people want to get hold of the asset and make the necessary business changes. The paper does recommend a variety of timeframes, but just like with the Commerce Commission, I think the proposals would allow, in substance, the regulator to decline and therefore
negotiate an extension. But I still think having the timeframe, some sort of the timeframes proposed in the paper would be beneficial. It would set a benchmark. The OIO would need to be resourced more so it could respond to those timeframes, but I think that would be overall positive for the investment regime.
The most liked question right now is around access to labour. This was mentioned earlier on, so this is probably one for Judith and Rob, although you could put your director's hat on, Cathy, from some of your other company involvement and answer as well. But access to labour is becoming a constraint to growth in the primary sector. How are Fonterra and Silver Fern dealing with this?
Look, I think there's two aspects when we think about this. One is really about simplification and being really targeted about which of the consumers and the customers we're going to get after, and how do we therefore simplify our range, our manufacturing. I think the other one is around innovation. It's going to take innovation, it's going to take automation, and really focusing on who can we partner with globally that can help us bring some of that innovation to market. Because to the point, it's not getting any easier, and to Rob's point, there's generations that don't want to come back to the farm, so we're going to have to help solve it from a succession point of view, but also I think from a productivity point of view.
Yeah, one of the other boards I sit on has a reasonable investment in apples, and getting staff to pick apples is a fundamental problem. Many of the regions, and Silver Fern Farms by and large sits in the space too, we are at full employment in the regions, have been for years. If you are unemployed in Balclutha, you have a problem. And yet we can't find enough staff. Robotics will be part of it, and Judith touched on that. I don't know if you saw the robotic apple picker on TV about 3 or 4 weeks ago that Turners and Growers is bringing over. That will form part of the solution. Right now, there's 7,500 RSE workers running around in the Hawke's Bay picking apples as fast as they can. Well, they're probably going home now. The season's largely over. But that wasn't enough. There were apples left lying on the ground. We struggle to keep our plants open at certain times, certainly doing the value-added cuts, because we just don't have enough staff on the chains. It's not sexy. One of the things that the Primary Sector Council that Lane Jager is heading up at the moment is looking at doing is how do we create a vision for the food and fibre section in New Zealand, because there is a fundamental disconnect between young people, urban people, and what's happening in the rural environment. I think when it was touched on the Huawei presentation before, the Internet of Things, the data that we will be manipulating, the productivity gains that we are getting on farm and will continue to get, this is one of the sectors where New Zealand's growth is going to come from. It's not about getting more, it's about creating more value out of what we do. The future is incredibly bright, but the gap is large and we need to bridge it. Right now we haven't got that in place. And my daughter's friends at university think that I sell tobacco when I sell red meat. I think it's absolutely ridiculous, but that's what we're dealing with, so I'd be grateful for feedback on that.
So Bruce Cameron this morning made similar comments in relation to Zespri when Christopher Lux had suggested automation and robotics were the solution for the industry. But of course, robotics, AI, automation, they do require an investment of capital, not insignificant investment of capital. We heard Minister Parker this morning talking about his 15% R&D credit. Where do you think we are from an R&D perspective in New Zealand in terms of trying to solve that capital gap, and is a 15% R&D credit going to do it?
I think that there's another element to that, which is it's only for small companies. So for large companies like ourselves, yeah, we spend north of 70 million a year on R&D, but we need to spend more, and we're going to need to spend more to overcome some of these issues, which aren't low-hanging kind of product innovation challenges. These are obviously structural business challenges, and I do think the government, when they think about investment for the future, be it sustainability in its broadest sense, probably going to need to think about how they can help us and partner with us to bring some of this innovation to fruition.
Sometimes, a lot of government officials and so forth, I occasionally hear, they don't like tax concessions. They don't like things like R&D, tax deductions. But I think that's just sort of typical sort of official theory. Because if it makes a difference in practice, it means that people will invest in some R&D that would otherwise not, then overall, if you take a long-term view for New Zealand, I think that's a good thing.
The best example in the meat sector that I've seen with R&D recently is the primary growth partnerships that are now defunct under the, they've run their time pretty much, or running out. And that was a great example of where the government was prepared to co-fund with people like Fern Farms who were prepared to put money up, but to take the full position it was far too risky. And that's been significantly beneficial to us as a company and many others as well. I would love to see something like that rolled out again. I think, as I said earlier, I'm the first to admit that our R&D spend is not where we wish it to be, but I don't think that, firstly, we're going to be spending it in other areas for a start, because we've got so much to do. And secondly, I'm just not quite sure if 15% is going to move the dial, to be honest. It might need to be more targeted than that.
So following on from that, there's a question here around investment that's being made into product provenance traceability. You can extend this out more broadly, I think, into the primary sector around the work that's being done on farm around environmental sustainability, and it feeds into product provenance traceability, our long-term branding in offshore markets. It's short-term investment for long-term gain, and the question is it leading to premium prices today, or is it just an additional cost that's now being borne by the sector?
I think you're absolutely right. I think first movers do have an advantage in terms of price premium here, but I think there is an expectation over time that it will just be part of the supply chain, and it will just be, we won't pay more for it, but equally we won't purchase if it's not there. And I think it's not just about traceability. I think, the way that sustainability is going, I think that will be something else where consumers will say, I'm willing to pay more now, but down the track I expect everybody to be doing the right thing by the environment.
I think that's absolutely right. I mean, I have a saying, these are green fees. You pay the money to get on the course. It doesn't guarantee you're going to have a good game. It's up to you. This will be part of doing business. In some cases it is. So I flip this in my own mind when I talk to farmers. It's about, this is protection of the premium position you've got at the moment. We mightn't be able to monetize this, but if we don't do it, watch it erode. We're a high-cost producer of animal proteins, and grass-fed systems are highly expensive to operate. So we need to leverage every point of difference we have. Traceability is just part of that deal, and it might not be a revenue generator.
Cathy, there's a question here from Frankie Wong, and if I'm interpreting it correctly, Frankie, it's your question for Cathy is effectively, are we seeing offshore investors walk away from the investment decision because of how long it takes to get approvals through and the uncertainty around it? Correct me wrong if that's not right, Frankie.
Look, I think it's very hard to say. I mean, I don't think so. I think that there's a lot of offshore money, in particular, looking for quality investments. I think undoubtedly it's a factor that people will assess, and I think particularly if we make our regime, tougher, so that it becomes more vague and less certain about whether or not, if you invest millions, because you do, if you come and do a significant transaction in New Zealand, say the one that Fonterra's been looking at, the sale of Tip Top, those bidders will have spent large sums of money with various professional advisors, and so they want some certainty that they're going to get consent. So I don't see the length of time frame mean that people aren't bothered, and probably the people that have turned off, I think typically it may be people who would never have got consent. So I don't really see that currently happening.
There's one here about the internationalisation of the renminbi and how that will impact on New Zealand entities looking to fund themselves. Might flow that into a question that has scrolled off but came up earlier, which is all around the Chinese regulatory position, and the question is really, I think, around what's happening in China, and is that impacting the ability of Chinese companies to invest in New Zealand today? And I might lead with that myself, if you like. having been there just a couple of weeks ago, and I think and interested in your views on this, but the message coming out of China very much is the fact that they're not especially interested in Chinese companies investing in casinos or hotels, but they are very much concerned to ensure that Chinese companies do have the ability to invest in strategically important sectors, and the primary sector in this country is clearly part of that. It's the theme I got. I'm not sure if you would like to add anything to that.
I think it opens up a whole new range of opportunities that 10 years ago just weren't present. You've got to tread carefully, and the challenge, and Charles touched on this quite well, I thought, in the previous presentation. China's just one market. It's an important one, but it's just one market. We've got to tread the line very carefully with all of the markets that we deal with. And sometimes they don't agree with each other, and we're seeing a good example of that now. But we deal with everybody. So that's the market perspective. From a funding point of view, from how China's opening up, not only in terms of funding, but services like insurance provision and things like that, I think there's a heap of opportunity that's coming out of China for not only this market, but globally, that really hasn't been available before. Now, maybe I'm seeing that because they view us as a Chinese company, I'm not sure. But certainly it's opened avenues for us to consider that previously weren't really there.
Certainly conversations I think we had a delegation from Beijing down recently who are investing over here. And I think, to your point, they are looking in particular sectors, but I think also to the point Rob made earlier, let's be really clear about who you're doing business with, and making sure that your values and your intentions are aligned down the track.
There was some discussion this morning in the context of trade flows around the role that business has to promote better market access, addressing some of the friction issues that emerge periodically, versus the role that government has, and how much time the government should be in market, whether it be the Prime Minister representing New Zealand at a very senior level into China, or the Minister. In relation to capital flows, how do you think the balance sits at the moment with business versus government, both in terms of outbound and inbound? What more do you think business should be doing, and where do you think the government has a responsibility to play?
I'll start with the government. I mean, I think the government has a responsibility to make sure that the rules are clear, and not to make statements, I think, which is Charles was alluding to, that might offend our significant business partner. So I think they have a responsibility to get those things right, and then I'll leave it to the business people to comment.
Something that would be incredibly helpful is if Jacinda gets up there more often. The head-to-head, there is no better place to build that relationship, and we've got a bit of back filling to do. So that would be my plea from the government, is get out there and do the job to make it easier for us to come in behind.
I think the trade delegations like the one that Minister Parker hosted, I think going hand in hand, speaking with one voice, I think it certainly helps, and I think the more of that we can do, and the relationships that get built across different organisations within New Zealand when those delegations happened, I think really serve as well going into the future.
I'm going to quit while we're ahead insofar as getting out before the alarm goes off. So can you please thank the panel? Interesting session.